Thank you so much for joining me, Sam Balsara and Vikram Sakhuja. Looking forward to this
pleasure.
very enticing conversation on the pitch report that you've just unveiled. First things first, you have stated that the industry is expected to grow at about 10.4% in 2020. You're also stating that we closed 2019 at about 11%. That's about 67,000 odd crores 2019 and expected to touch about 75,000 crores in 2020. Is this reason for us to be happy or just about, all right and accepting the new normal?
Until last year, I used to also talk about these figures, but I think this year the realization dawned on us that perhaps to make our report a little more meaningful and actionable, I think we should look at traditional media and digital separately.
Okay.
Because I think the two are behaving very differently and almost conversely.
Okay.
So that is why from this year onwards, we've decided, given the way digital is
performing,
going up and away and growing at 30% and 32%, and our projection is 27%. And for the other media, we are talking about 3% and 5% and 6%. If you combine the two and just put out one figure, then actually it conceals more than it reveals.
True, yeah.
So in my book, the 10% is a meaningless figure. I think we have to see traditional media and
digital in different lights,
in different lenses, and then the figures begin to tell a different story.
Sure. So let's do that.
For example, according to us, traditional media in 2019 grew by 6%.
Okay.
And digital by 32%.
Okay.
You combine the two and you get 11.
Okay.
So that's the story we want to talk about.
Sure.
And also within traditional, although the average is 6%, you have cinema, which is of course only a 1-2%
contributor to the
ADEX. Growing at 30%, and you have print and TV, which are the two sort of big boys, which have grown at 8% and 3%. I would say the big story is that in spite of everything that digital is doing, television continues to be the largest medium, the largest contributor, and despite all the knocks that television took during 2019, it still grew by 8%.
I see that you're very optimistic. But having said that, I'm truly curious about, demarking traditional and digital separately and looking at, let's say, first just the traditional story before we move on to digital. And when you're saying that, it has grown by about 6% in 2019, and you're estimating 2020 for it to grow by?
For it to grow by 5.1.
5.1 overall traditional, TV at 7.
Okay, so 5.1 versus 6 of 2019. So there is going to be a slowing down of growth for traditional.
Well, that is because we expect the slowdown to really taper off only by Q2.
And why do you expect it to taper off?
Well, we think that some green shoots are already sort of appearing, and we think, by the time festive season sets in, things should improve dramatically, and therefore what we are seeing is a very slow Q1 and Q2, a decent Q3, but a very buoyant Q4.
And here we're talking about the calendar year.
I'm talking about calendar year, of course.
So, feel free to input on why there is confidence that H2 will be more robust. What are the factors you think that you see that,
if I may
in
take
the works?
Even when this time when we were trying to get our 2019 estimates, we broke it up quarter by quarter, and we actually reported half and half. So if you have to actually, you have to get pretty granular about it. Like if you look at TV, in the first quarter of 19, the NTO had a certain negative impact.
Sure.
Second quarter was rock and roll on the back of an IPL, a World Cup, as well as elections. But then Q3 and Q4, because of the downturn, started looking bad. This year, we expect that pretty much, now I'm talking TV, that you actually don't have the same Q2 kind of buoyancy, because there's one World Cup which is getting out of Q2 and going into Q3, Q4 actually, October. And we don't expect the elections, of course, in the same quarter. So we don't expect the second quarter, the growth generators, to actually be operative this year.
Okay.
But the same thing, if you look at a World Cup coming in October, on top of that, you're cycling actually strong negatives, you actually can expect a pretty high growth. So when you look year on year, it's simple math, you'll see actually on the back of a small base, you'll actually get better growth.
My question is, as you all are veterans in this industry, and you know every report, whether it's yours or whether it's GroupM's, is showing the fast-paced growth of digital. Given the fact that there's a lot to be desired still from the medium, whether it be in terms of efficacy, actual deliverables,
or third-party
measurement,
or third-party monitoring.
Exactly. Everything seems to be a gray area. So how is it that clients are still willing to spend? Because I was speaking to some people from Google and Facebook, and they seem to be very clear that they don't want to be part of this whole measuring business. They're very happy, and they are actually arrogant enough to say, hey, listen, if you don't see value, don't advertise. So given this scenario where everything is in the dark, how is it that we're seeing client sentiment so pro towards digital?
One of the reasons is that as long as the performance game is there, so despite all the measurements, performance is finally at the end of the day cost per download, cost per sale, cost per walk-in, cost per whatever, but it's a very measurable business metric. If the business metric is being sort of achieved, in that case, the via medias of saying that you did not give me, it was seen by a bot or seen by a human being, or how many people or how many impressions, that frankly becomes meaningless, because finally the proof of the pudding lies in somebody buying you or walking into your store or thereabouts. So on the performance game, actually digital has a very strong story. And even the lack of a measurement in the via media on the mind metrics shouldn't be a sort of factor.
Yeah, but
for advertising, it should, because there are still a fair amount of cost per views and cost per thousands being sold.
Sure.
On those, it remains an issue. At this point in time, at our event, the panel that I was running, I actually put this question to one of the panelists and said, doesn't it bother you that you are actually accepting the bills from a media owner, and those bills could be at a variance from what a third party measurement agency actually provides? And the truth is, they were uncomfortable about it, but they did not do anything about it.
Because they don't have a choice.
Either they don't have a choice, or they're not just pushing it hard enough, or it's still not reached material levels. But
no, don't say they don't have a choice. They have a choice not to advertise on
like
the medium.
BNG.
But they still do, which is an indication of the strength of the medium, and the fact is that somewhere they believe that it is delivering. We may not be able to give them proof for every one spot and every bill and everything verified, but somewhere they do believe. In fact, I know of a largish bank that is currently experimenting with virtually 90% digital. A bank that was until I would say 2-3 years ago spending probably 50-50 is now experimenting with 90-10, 90 on digital and 10 on traditional to check out.
Mahindra.
Yes.
Yeah. But see, but Karthi mentions that it is an experiment, and we don't know how that outcome will be.
Yes, but the fact that you don't
Sonali,
conduct experiments unless you have a strong
Sonali,
reason
reality is that up till now, now that the digital is reaching 27% of the spend, and at least about a half of that is going into advertising per se. So 13% of advertising is going to be sort of looked at closely. Now, if outdoor also didn't have the best of measurement, but it was chugging along quite well, and we've been improving it year on year on year. But at this somewhere, I think it's going to reach the inflection point where the demands will become very high. And I think, at least my personal view is, the digital giants would be better served to actually follow a third party, because what you don't want to do is take it to that level and then fall off the cliff. Because some of the large global advertisers, when they go off, they correct in a very dramatic manner.
Sure.
So
We've already seen the likes of P&G do that. But I mean, it seems to be that, you know, I mean, at least from an India standpoint, even a global standpoint, they seem to be quite blind to all the deficiencies.
Thousands and thousands of others who kind of think it works well.
You know, let me also ask you about the forecast that, you know, Madison has made. And actually, this is a year-on-year, you know, confusion that people like us face, where, you know, for instance, you have ended the year in absolute terms, in terms of ADEX expenditure at about
75,000. Next year, 75,000.
No, 2019, 67,000 crores. And you are estimating 2020 at about 75,000. Now, the GroupM this year, next year report has stated that the industry has ended 2019 at about 82,000 odd or 81,000 odd, and we will end 2020 at about 92,000. So,
yes, I took a look at that,
yeah,
and I'll tell you the major difference is in television
and digital.
The figures that they estimate for television, I believe, are overestimated.
Okay.
And one can easily check that out, because, you know, television is not so fragmented. Just look at the results of the top 5 or 6 networks, and you'll be able to estimate what the television market is. Our belief is that our figures are a lot closer to what the reality is.
Okay.
So we are not just doing some mathematical calculations, we have also done a cross check with actual data of companies in terms of financial data, and we think our figures are a little closer to reality.
Okay. You want to add to that?
So there are 3 checks that we do. We look bottom up from advertisers and see what is the numbers that you get. We work from the broadcasters or the media owners and see what are those numbers. And then we also see agency, whatever the reported agency billings are and the shares are, try to take the share of that market. So when these 3 things triangulate, we come out to we get our confidence. At this point in time, like Sam said, they are 20%, GroupM is 20% higher than our estimates on TV and also on digital. On print, and in fact, they're a bit lower than us, and I think out of home and radio, they're pretty similar to us. So if you actually had to do the same 3 things, take agency share, take broadcasters, take media owners, and try to triangulate, I think we can explain. I'd love to hear the explanation.
Sure, sure. I'll do that panel with you, Prashant, you know, Shashi.
I look forward to it.
And then we can have a hot debate.
Yes,
debate. But you know, coming to OTT, you have talked about the fact in your report that you will possibly start seeing a consolidation starting 2020. That's great news, because we have only so much real estate in our phone. So it's difficult to, you know, look at any number of OTTs, you know, 2 or 3 are enough. So what is your, you know, prediction in terms of how we'll see this landscape consolidate?
I think there is already one too many OTT players, according to me, and most of them seem to be in a heavy investment mode.
Right.
No, I think somewhere at some time somebody is going to pull the plug. As we have seen, I mean, you know, whilst a lot of people are willing to invest in India and in Indian media, you know, it isn't as if that it's a, you know, bottomless sort of or an open tank.
Yeah.
So we feel that some consolidation will happen, because somebody will run out of money, somebody will get exhausted. And because anyway, we think the market cannot absorb so many serious players.
I want to talk to you specifically about OOH and the fact that, while you stated earlier that you are happy with the kind of growth it has shown, wouldn't you say that given the fact that it is such an old medium and has been here for time immemorial, if you just compare the Indian OOH market and juxtapose it with, even smaller countries, don't you think that it has just not evolved as a medium? We're still looking at the same plain vanilla hoardings. There's been no real style,
See, the reason
Yeah.
why it has not evolved is unlike in the Western markets,
or even in the other Eastern markets.
no, or even in some of the Eastern markets, like in other media, OH is highly consolidated and maybe there are 4 to 5 or at the most 10 operators.
Okay.
In India, Madison itself deals with 500 contractors. At one point we dealt with 1,000 and we brought that down to 500. You can imagine the amount of fragmentation that is there. So there is no one who is really able to make big time investments to upgrade the sites, standardize the sites. And along with that comes our very suspect regulation, because people are scared of investing. You never know, tomorrow morning some government changes, says okay, no hoardings, or somebody says no, you can't do 30 by 40, you have to do only 20 by 10, or suddenly the taxes are increased 300%, so it becomes uneconomic. So I think for essentially these two reasons, I think are preventing outdoor from modernizing and standardizing and offering all these sophisticated evaluation measures.
Are you saying that these problems are not there in other markets, in Asia, that have managed to modernize their whole outdoor industry?
I dare say that I think in many other countries that I've heard about, entrepreneurs are less possessive and less emotionally attached to their businesses than we are in India.
Okay. That's interesting, because it's unfortunate given the current scenario and the number of jams we're stuck in. It can be a very, very engaging medium if done right. It can be possibly
So
more.
I think there are some green shoots. I think some of us agencies have brought in better measurement. So traffic count was something that we weren't really looking at till some time back. Now thanks to technology, the entire Google Maps algorithms and stuff like that, you can actually now give some pretty credible traffic counts. We've had site quality for a while. We've extended it from billboards to bus shelters. So there is a sophistication and planning has definitely improved. There is also going to be a green shoots of the entire programmatic outdoor. So the inventory on this is still small, but that is really now interesting. So
for that you'll have to digitize it first,
Yeah,
right?
but there are already maybe 100 sites.
Yeah, there are
100, yeah, okay.
So this is very, very small, but we are really experimenting with them big time. And great innovation is possible.
Exactly.
So and it's already happening, but it's only thing is the scale has not been achieved.
Okay.
So it's just a matter of time. I think it's going to work much better than some of the entire retail OH and stuff did. So I think this one will shoot.
Just to jog your memory back at the report, there were some key learnings or rather insights that were pointed out in the pitch report, and one of it was the fact that you've stated that for the first time in 7 years, consumer growth in rural is slower than in urban markets.
This is not actually our data. This is reported data by, I think it is Nielsen who has reported this.
Right,
yeah.
But this was the insight in your report. What would be your, let's say, advice to marketers on how to combat this and look at it from a strategic business point of view?
Well, I'm glad you raised this. Maybe Sonali, you should do another program on Madison's marketing playbook for advertisers, or what they should do in a slowdown, which is 10 pieces of advice what marketers should do in the current situation where there is a slowdown. So we talk about tapering expectation from rural, we talk about premiumization, we talk about concentrating in a few states, we talk about ESOV, that is your SOV should always be higher than your SOM, in which case you're more likely to gain market share, and a few other points like that.
Sure. I want to ask you one question before I wrap up this interview. If you've looked over the years at all media, so whether it be print, TV, radio, even digital, would you say that they've been able to up their pricing as the years have gone by? Have we seen, let's look at the last 5 years.
Pricing in media has two elements to it. One is a cost per thousand and one is the absolute prices.
Sure.
So I think when absolute prices may have come down, but actually unit price or cost per reaching a consumer, there's definitely inflation. And I think one of the reasons for that is very high fragmentation, and that causes
I'll just build a bit on that. I think the impact inventory effective rates have gone up, but on base inventory, regular inventory, the absolute rates have held or gone down. But like Sam said, the cost per thousands have increased.
But why has it gone down?
We also think, talk about your tribal versus...
If I was to make a construct, this is something which I've been following for some time now. Think of an axis. X-axis is the cost of the inventory. So left to right is high cost inventory like an IPL, all the way going down to really long tail channels where you can buy for a few $100. And the y-axis is the amount of spend that you're doing in your plan on each of these. In the good old days, we used to shun the very, very expensive programs and the long tail because it never added reach, and we would sort of go on the middle of the body where you could get reach and actually build pretty efficient plans. In today's day and age, actually it's become very interesting. You will actually spend a fair amount of money on the very expensive programs like the IPLs and KBCs and Big Boss and Kapil Sharma shows, and these are what we call tribal moments. There's a chance that if I can come and ask you that yesterday did you see the Kapil Sharma show, there's a good chance that we might actually talk about it, and maybe even a chance that we might have discussed the advertising that was played on it. But now the long tail, which earlier had very little value, thanks to addressable stuff, has now suddenly taken on value. So now the humps rather than going to the body of that entire thing, there's a case for buying impact, case for buying long tail, and still being able to construct very good reach.
Before I end this interview, last few thoughts or learnings that you would like to share with the industry at large, and even maybe things that you want to caution the industry.
I would say a big opportunity or a big sort of change that should work for both the media owner as well as the advertiser would be a combined offering of television plus OTT, and for the print titles, print plus display in the same title. And I think that could make a paradigm shift, and it would make us more sort of pro-brand and help brand equity and make consumers also focus on the content that the media brand is capable of delivering rather than the medium on which it is being delivered.
Sure.
Well, in a way, I mean, it's this thinking that has led the Times of India to brand your show the brand equity show.
That's true.
Or why is ET now called ET now?
Yeah, sure.
So I'm just extending the same logic, but now you offer
next
step.
If I can add one onto that, I'd say third-party measurement. I think it'll unlock more growth for digital. They do have nothing to fear. They should embrace it. If they do, all the kind of trepidations people currently have will be removed.
Fair enough. On that note, thank you, gentlemen. This has been truly insightful, and let's hope for a path-breaking year for all our careers and, of course, the business at large.
I'm sure it will be. Thank you, Sonali.
Thanks, Sonali.